Welcome to this explainer. Today, we are doing a complete forensic teardown of the Red Herring Prospectus for Susan Electricals. If you're a retail investor trying to see past the surface-level hype and really understand the deep financial realities of SME businesses, you're in the exact right place. We're going to dig into the raw data, line by line, to see what is actually going on under the hood of this company.
Before we jump in, a quick but absolutely crucial reminder. This explainer is strictly for educational purposes and does not constitute financial advice. Always consult a SEBI-registered advisor before making any investment decisions. We're just here to read the financial x-rays, not to tell you what to do with your capital.
All right, here is our roadmap for today. We'll establish their business model, track exactly where the money is going, do a forensic deep dive into the financials, unpack the promoters and structural risks, and finally, stack up their valuations.
Let's kick things off with Section 1, getting a baseline on their actual business model.
So, what does this company actually do? Incorporated back in 2007, they manufacture copper and aluminum winding wires and strips. And we're not talking about the wires in your walls at home. These are highly specialized components used specifically in power transformers, which means their success is practically tethered to broader infrastructure development and industrial power demands.
They run all of this out of a dedicated facility in Ghaziabad. Now, the real engine of their operation? Government tenders. They're approved vendors across multiple states, which is huge for them. It allows them to bid directly on government contracts. Promoted by Vishal and Mahak Jain, this B2G and B2B structure is essentially the bedrock of their entire business.
Moving to Section 2, let's follow the money. Why exactly are they raising these funds? Looking at the issue, we've got a fresh issue of up to 47.42 lakh shares, alongside an offer for sale of up to 8 lakh shares by promoter Vishal Jain. But here's the part you really want to pay attention to. They are explicitly earmarking about 1,080 lakhs of those fresh funds strictly for CapEx to expand their current manufacturing unit. That's a solid indicator because it shows they're actively routing money into physical asset growth rather than just using it to bail out old debt.
Now for the really fun part. Section 3, our forensic financial deep dive. Let's look at the X-ray. Just look at this progression leading right up to the IPO year. It's wild. Revenue goes from around 10,300 lakhs in FY24, bumps up a bit in FY25, and then absolutely explodes to over 26,900 lakhs in FY26. But if you think that's steep, wait until you see the margins. To put those numbers into perspective, their profit after tax went from a super modest 75.58 lakhs in FY24 to a massive 1,824.64 lakhs in FY26. Let that sink in for a second. That is a 23-fold increase in profits in just 24 months. As a forensic analyst, whenever I see a parabolic spike like this right before a company goes public, it literally screams for deeper scrutiny. We have to ask, is this a sustainable new baseline or just a temporary pre-IPO sprint? And that brings us to a fascinating and frankly kind of glaring anomaly hiding beneath that massive revenue growth. Here's the catch. While revenue was going to the moon, the percentage of repetitive returning customers took a nosedive. We're talking a drop from nearly 89.5% in FY24 all the way down to just 45% in FY26. So what's the takeaway here? This explosive growth wasn't driven by upselling their loyal, established base. It was driven by hunting down brand new clients. And that introduces a very real structural question. Can they actually retain these new buyers, or is this revenue stream inherently volatile? Which naturally leads us right into Section 4, the structural realities and key risks. To really grasp the risk profile here, we need to talk about leverage. In simple terms, the leverage ratio measures total debt against equity. It basically tells us how much a company relies on borrowed money to keep the wheels turning. Higher leverage means higher potential returns, sure, but it also means significantly higher structural risk if things go south. And the balance sheet paints a very clear picture. By the end of FY26, they are carrying a heavy debt load of over 6,671 lakhs against a net worth of just about 3,847 lakhs. That leaves them with a leverage ratio of 1.73. For a manufacturing business, heavily funding your working capital with debt makes you vulnerable, especially if the broader economy tightens or, think back to our previous point, if those brand new customers suddenly delay their payments.
All right, Section 5. Let's do a reality check on their valuations.
The prospectus lists a weighted average earnings per share of 8.07, but the real jaw-dropper is their return on net worth for FY26, sitting at a towering 64.64%. Now, 64% sounds absolutely phenomenal on paper, but remember the context we just built? High debt naturally inflates your return on net worth, and we already know this metric is heavily skewed by that sudden 23-fold profit spike right before the IPO.
Let's wrap this all up in Section 6 with our summary and final thoughts.
We've unpacked a massive 23-fold pre-IPO profit spike, a pretty stark drop in repeat customers, and a highly leveraged balance sheet supporting the whole operation. This is the perfect reminder that SME IPOs carry inherently higher structural risks and volatility compared to main board companies. You are dealing with specific data anomalies here that require strict, emotionless scrutiny.
So as you weigh these hard facts, the aggressive top-line growth against the heavy debt and customer churn, you've got to ask yourself, how does this reality align with your personal risk appetite? Are you comfortable with a high-growth, high-debt sprint? Remember to consult a registered advisor, keep questioning the numbers, and I'll catch you in the next explainer.